So today we're going to be talking about if you're someone who owes the IRS money due to a tax liability that was created by your spouse or your ex-spouse, or if you're considering marrying someone who already has IRS debt or are married to someone who had IRS liabilities prior to marrying you. Any of these situations, you may be wondering whether the IRS can come after you for that debt. Well, it's somewhat complex because the answer depends on several things, including whether you were legally married, when the debt was incurred, whether you filed a joint tax return with that person, when the debt arose, and whether you live in a community property state. I'm Bob Jablonsky. I'm a tax resolution specialist, and in this video, I'll explain when your spouse's tax debt remains theirs alone and when it becomes, or at least when it can become, your responsibility, and how it could affect your tax refund or jointly owned property. Let's start with the situation that creates the least risk when you aren't legally married. So, that one, like I said, is somewhat simple, pretty simple. If you're not legally married, you're generally do not become responsible for your partner's federal tax debt simply because you live together, you share expenses, or have been in a relationship for many years. The IRS cannot ordinarily make you pay another person's tax debt merely because you're their boyfriend, that you're their girlfriend, you're their fiance or domestic partner. That part is pretty straightforward. However, jointly owned money or property can sometimes create practical complications. An example of this is the IRS levies a bank account that's in both of your names. They're not going to take half of it in that case. And what may happen is after it's levied, you may have to document which portion of the money belongs to you in order to get it back. Now, let's look at what happens when you are married. Marriage by itself does not automatically make you personally liable for tax debt your spouse incurred before the marriage. If your spouse already owed the IRS when you got married, that normally remains your spouse's separate tax liability. But that does not mean the debt can never affect you. An example is you're now married. They have that tax debt they owe the IRS. You file a joint return and you're expecting a refund. Well, the government is often going to apply that joint refund to your spouse's old tax debt. And that can happen even though you were not personally responsible for that debt. What do you do in that case? Well, you may be able to recover your share of the refund by filing a Form 8379. It's called an injured spouse allocation. That's not really what we're covering today, but in this case, you may be filing requesting an injured spouse allocation. And the term injured spouse is confusing. It's not, we're not talking about physical or emotional injury. It means a portion, generally means a portion of your joint refund was or expected to be taken to pay a tax debt that legally belongs to your spouse. It's fairly simple in a non-community property state that you can file that injured spouse request. It can be complicated if you reside in a community property state, so be aware of that. Now, here's the situation that creates a much greater risk, and it's generally what we're talking about. You're married and you file a joint tax return that has an unpaid balance. Remember, when you're married, you have the option of filing jointly or separately. And when spouses decide to file jointly, both spouses are generally jointly and severally liable for the entire amount owed. That means the IRS can pursue either spouse for the full tax, penalties, and interest, not merely half. And I have people come into me all the time and they'll say, Bob, well, my half is, 50% of it. No, you both are jointly and severally responsible for the entire amount. And the IRS can collect it from both or one of or both of you, however they can get the total amount of the money. And it doesn't necessarily matter which spouse earned the income that's causing the problem. It also doesn't necessarily matter that one spouse handled all the finances or promised to pay the tax. As a matter of fact, even a divorce decree stating that your former spouse must pay the IRS does not ordinarily eliminate the IRS's right to collect from you. The divorce agreement may give you a claim against your former spouse, but it doesn't bind the IRS. So, what if you filed separately? If you filed separately, married filing separately, you are generally responsible for the tax shown on your own tax return, not on the tax shown on your spouse's separate return. However, once again, community property states can make this more complicated. These states include Texas, California, Arizona, Nevada, Washington, and several others. Community property states laws, they may affect how income, withholding, refunds, and property are allocated between spouses. They may also affect which assets the IRS can reach to collect on one spouse's separate tax debt. Therefore, living in a community property state does not necessarily make you personally liable for your spouse's tax bill, but it can allow the tax bill to affect your income, your refunds, or your property that you considered yours. So our final situation is going to be what happens if you did sign a joint return, but the tax problem was caused by your spouse. And you may have heard of innocent spouse relief. And keep in mind, innocent spouse relief is very different from injured spouse relief. Injured spouse relief that we talked about earlier generally concerns getting back your portion of a refund that was applied to your spouse's separate tax debt for a problem not directly related to you. It's their tax debt, but they took money that belongs to you or assets that belong to you. Innocent spouse, on the other hand, it concerns whether you should remain legally responsible for some or all of the tax from a joint tax return. An example of this may be your spouse, maybe you filed a return, maybe you signed the return, but it goes through audit and it's found that your spouse may have failed to report income, claimed improper deductions, or provided incorrect information without your knowledge. And depending on the facts, you could potentially qualify for innocent spouse relief, separation of liability, or equitable relief. There's three different options there, and but they're generally all made using Form 8857. Innocent spouse relief is not automatic. The IRS is going to consider what you knew or had reason to know, along with your financial circumstances, marital status, involvement in the finances, and whether holding you responsible for what would be unfair. Another example of this is maybe you weren't aware of the tax returns. You earned no income. You didn't have a requirement to file taxes. Your spouse was filing these tax returns, signing your name without your approval. So, to wrap this up, the short answer is this: if you're unmarried, you're generally not responsible simply because you're in a relationship. If your spouse brought tax debt into the marriage, you generally don't become personally liable by getting married, but the debt can still affect joint refunds and possibly jointly owned property. And if you sign a joint tax return, the IRS can generally hold you responsible for the entire joint tax debt unless you qualify for some form of innocent spouse relief. I'm Bob Jablonsky, and I help taxpayers resolve serious IRS problems. If you or your spouse owes more than $25,000 to the IRS and you need help evaluating your options, give me a call. I'm at 972-821-1991, or you can use the link in the description below to schedule a consultation.